Good morning, good afternoon, and good evening, whenever and wherever you're watching this. Back by not popular demand, but I guess back by very small demand. Mike and I are
Semi-popular
here
demand.
to, yeah, slightly popular demand, our three followers.
Someone's asked for this.
Yeah, exactly. We're back. It's been, I think, probably 6 weeks since we did our last one. We want to get two more kind of uploads in before the end of the year because we're starting to get a lot of questions on where the market is. I think people are starting to see a bit of call it a shift. Maybe a shift is too strong of a word, but we're starting to see a little bit of momentum coming back, particularly here in Toronto. And
Things are starting to happen. We've been in COVID for a while. Company again, things are shaking loose. So we got a lot to talk about today.
yeah, that's a good way to put it. And well, we thought we'd bring in the best person able to talk about that. So for those of you who don't know, this is Julian Lo. Julian is actually Montreal born and raised, I believe.
Correct.
He is a former actor, including he's been in movies with Zach Braff. But the reason he's here today, not to talk about his acting career, though we could go talk about that at the end, or if anyone wants to hear about it, just hit us on the DMs and we can give you Julian's address. The reason Julian's here is Julian is our senior analyst for our research team based out of Toronto. And he's actually just recently written our Q3 national report and Toronto reports. So if you like numbers, if you like statistics, if you like research in general or market stats, which Mike and I love, Julian's the one who provides us all that type of stuff. So Julian, welcome. Thanks for being with us.
No, thank you guys. Thank you very much for having me. And I'm excited to chat about the market. I'm glad to have two people who love numbers as much as I do.
Yeah, it's the funny thing is like we're all in our own ways. We're so passionate about the market and the numbers in behind them. Anyways,
Julian's the brain behind the scenes. We're the voice boxes, and Julian's the one actually thinking up all the good stuff that we say.
Well, I'm hoping to get some good information here too.
Yeah, the sad reality.
Julian, why don't we let's jump in. Give us kind of a high level. It's been a long time since we talked about the market. Kind of the macro to micro nationally. What are we seeing in Canada in terms of overall trends with space across the major markets?
Yeah, absolutely. So, coming off the heels of Q3, Canada across the nation did see, its largest quarterly occupancy loss in over a decade since before 2010. So that's about nearly 3 million square feet in negative net absorption. And that has pushed the vacancy up to 10.8% as of the end of Q3 2020. So, that is definitely a big and notable number when you look at a quick glance over the Q3 stats across Canada. But I think and we talk about this more in the report as well. If you start digging deeper into those numbers, into what what's actually happening in terms of market dynamics that is pushing those macro indicators, then you get a bit of a mixed story. There's more nuance happening below the surface. That's not just gloom and doom. Things like leasing activity and growth positive absorption did come back slightly in Q3, especially after the near standstill of demand in Q2. So those are promising indicators, balancing out that huge quarterly negative absorption that we saw. So that really,
so Julian, just to jump in on that, like some of those stories. So we apparently had some of the lowest vacancy in North America across several Canadian cities. Is that still the case?
Yeah, absolutely. That's a great question. So yeah, even though we've seen, these significant losses, across most of the markets in Canada, markets like Toronto, Montreal, and Vancouver, these are markets that are still some of the most supply constrained markets in North America, especially the downtown markets in those cities. So if you talk about, downtown Toronto, downtown Vancouver, and downtown Montreal, these are three of the tightest CBD markets in North America. Currently, downtown Toronto is the tightest CBD market in North America at 3.8% vacancy. The city of Toronto has had that position since 2018, but is still at that prime top place, whereas downtown Vancouver is the second tightest CBD market in North America, and Montreal is the fourth tightest.
Interesting. So why don't we dive into Toronto, because that's what we want to spend most of our time today. So you said the tightest CBD market in North America out of any downtown, which is crazy. And let's talk about what's that movement been from where we were prior to COVID versus where we are now? Is it a little shift, or has that moved everybody a big amount?
No, that's a good question. And that's sort of the interesting thing that I've seen, in a lot of the reporting that's been happening since the beginning of the pandemic, right? It's a lot of, for lack of a better term, it's a lot of, the sky is falling kind of rhetoric, which is to a certain extent, I can see how people would see it to be true. Thinking about that nominal or percentage increase in terms of, something like vacancy, we'll take sublet vacancy, for example, which has been a significant driver of that growing vacancy rate, for example. And, the number that gets thrown around a lot is that sublease vacancy has tripled since the beginning of the pandemic.
So sublease vacancy has
true.
tripled since the start of the pandemic.
Correct, absolutely. So that is the part that is true. We have that sublease vacancy number has tripled, but then you want to sort of take a look at what was that base number that we started with, right? So at the end of Q1 of this year, we only had less than 300,000 square feet of sublet vacancy in all of downtown Toronto. So if you think about downtown Toronto as a 75 million square foot market, going from 300,000 square feet of sublet vacancy to just under 1 million square feet of sublet vacancy at the end of Q3, that number has tripled, but we're still at less than 1% of the market, right?
Right. So I think that's what's so critical. Sorry to jump in, Mike, but we're talking about, so we've thrown out a lot of numbers so far. So let's take a moment to digest what a couple of these mean. So let's push sublets to the side for now, because I think we want to come back to that, because that is going to be one of the stories that we talked about at the end. So you did reference vacancy rate is now 3.8%, according to our most recent notes. So that is still, and I think this is why it's important to put context around it. That's still the tightest market in North America. Correct. Right? That is still a marketplace that is difficult to find space in, though becoming less difficult because there are options. However, that's still double from where we were at the start of the year. Right. So when you think about, our market in Toronto hasn't necessarily been hit as hard as others have. Some have gone up double, triple, quadruple in terms of their percentage rates of vacancy over COVID. Toronto's only gone up double, but it is still substantial. To your point, in a 75 million square foot marketplace, another 2% of vacancy is a lot of space to fill. And that's before we even factor in the sublet availabilities, which don't count as vacancy because there's still a tenant paying rent on that space. So in terms of available options, I guess, if you will, that are on the market today compared to options that were on the market in January, because I think that's where we want to kind of focus this conversation. As Mike and I represent tenants, as you know. When we're out with tenants, the one thing that we're always asked is, well, what are my options if I'm 20,000 square feet, if I'm 50,000 square feet, if I'm 100,000 square feet? And we can't say, well, the good news is we're at 3.8% vacancy, so there's your options. So maybe digesting it you want to go from top to bottom. So 100,000 square feet, 50,000 square feet, 20,000 square feet. What do those options look like in the marketplace today compared to maybe how many options there were in January?
Yeah, no, absolutely. So that's a great question. And I think the best way to sort of digest it is really if you're looking at that upper echelon, if you're looking at that 50,000 plus, and especially once we get to 100,000 square feet plus, in terms of 100,000 square feet, we're still only at a couple of blocks in the downtown Toronto area. Whereas, at the beginning of the year, we were at zero. Tenants were looking at, future availabilities across the board, really, once you get even above 50,000 square feet. They were really looking at, future timelines in order to see what blocks would sort of shake loose from the market. Whereas now we've only grown to maybe, 2 or 3 blocks above 100,000 square feet in the downtown core. If you go down to 50,000, I think there's about a handful, maybe close to 9 blocks downtown or so. And that, still includes things that are coming available in the future. But that's really sort of been part and parcel for the story of, what those new availabilities that have been added to the market look like. And those are largely much smaller spaces than you would expect, especially when you hear things like, availabilities have tripled or vacancy has tripled. So those are, significant numbers, but they're comprised of, a large volume of smaller spaces. If you look at most of the availabilities that have been added since the beginning of the pandemic, we're trending at spaces that are 10,000 square feet or less on average.
Yeah.
So most of those availabilities and vacancies that are being added to the market are really quite small. It's really the volume of number of spaces being added that has changed since the beginning of the pandemic.
So if I'm hearing this right, if I'm a tenant, if I'm a big tenant, I'm hearing there's a couple more options, but there's still not a ton of options available to me today. But if I'm a small tenant, then I have a lot more to pick and choose from in the different pockets if I were on the market today.
Absolutely. That's exactly it.
But I think
do we have any forecasts on, I guess, so we're in a pandemic, we've seen a couple spaces. Do we have any foresight into what it's going to look like next quarter or next year in terms of large blocks coming? For example, everyone in this market follows the banks, right? The banks are the biggest space, and when they give up space, they're the biggest relievers of space. Do we have any expectations on how big of blocks could be coming over the next 12 months or so?
Yeah, absolutely. And that's a great question because, obviously downtown Toronto is a market that runs on financial services, right? In the past few years, we've definitely seen a bit more diversification in terms of the tenant mix, with tech becoming a big driver of office leasing. But if we're talking about occupancy, the banks are definitely the ones that still really move the needle in downtown Toronto. And, so far in the pandemic, we've seen that the banks have been largely pretty quiet in terms of the sort of space blocks that they might bring back to the market. We've seen some banks offload a floor or two here and there, but we haven't seen, those large blocks coming from really the large institutional tenants. So looking ahead, we're definitely still tracking that because they've been so quiet throughout this, and also because lots of, the major banks have signed on in significant ways to the new development, right? So
that's what I want to preference when we talk about this is, the difference between now and the start of the year is, well, we're 10 months later into our timeline, right? So when you're thinking about it from a large tenant perspective, call it the 50 to 100,000 and above, the average search time, or the time where you're actively reviewing your space requirements, are anywhere from, I would say, 12 to 18 months on the incredibly short end. Most likely it's somewhere from 2 to 4 years out. You're starting to really review your options. So what's changed from the start of this year to now is, one, we have a little bit more certainty around the new developments. So who's moving into them, obviously, and more importantly, where that backfill space is coming from. So to your point on the big banks, most of the big banks in 2017, 18, and 19 did lease new towers or new developments downtown, which will leave backfill space anywhere from 1 million square feet per bank to a little bit less than that. So when you think about that, those will be large block opportunities that hit the marketplace. The other thing that's changed in the timeline is we've shifted forward an entire year, right? So options that maybe in early 2020, late 2029, where a tenant might not have been looking at their lease requirement in 2024, they are now starting to look at that lease requirement in 2024. And there's options on the market that they can hit that timeline in terms of new construction as well. So I think that is the biggest difference in that large block category. There are a few more opportunities on the market available today if you wanted to move in essentially tomorrow. But there are more coming, I think, on that horizon. And our forecast, as Michael referenced earlier, does show a few more options in that sense. So, so from a large perspective, or a large tenant perspective, I think the pandemic will actually end up being probably a positive. Because there are going to be more options on the market once things kick off again. And what we're hearing in the market is things are starting to slowly kick off again as more and more, I guess, certainty and encouragement comes around when it comes to vaccines, which really does.
That's a great point. I think one of the key messages of this podcast today with the market is we were in the hardest market to be a tenant in North America and one of in the world, and now there's more options. There's more options.
Right.
Losing, although it's not, talking to a landlord who has a lot of space in San Francisco about a couple weeks ago, they're seeing waves of space at the market, whereas in Toronto, we're still tight. It's moving, but it's not throwing itself in one direction.
Well, again, Mike, I think this is really critical. We have to define that. So at the start of this year, we were, I think you just said, the hardest market in North America to lease space in. We still are. Right, we still are physically the tightest market in North America, but our options on the market have actually doubled since COVID. That's exactly right.
The whole timeline shift. The whole.
I think that's important. So let's because we talked about it at the start, and I think it is the thing we're hearing the most is, what about the sublets? So Julian, let's just recap those stats that you talked about at the end, and then we're going to put some context around everything. So
Yeah.
Currently on the market today, how many sublet availability, square footage on the market? What are we tracking?
So current sublet availability is over 30% of total availability today in downtown Toronto, which is a significant proportion. We haven't seen those proportions in over 2 decades. So that definitely is sort of where, the battleground is headed. Especially if we talk about at the beginning of the call when I said, sublet vacancy has tripled from 300,000 square feet in Q1 to over 900,000 square feet at the end of Q3. On the flip side, like you said, that vacancy does not include availabilities that are not yet vacant, right? Which is really a lot of these sublets added to the market as. And so in that way, we're definitely seeing a big proportion of availabilities as sublets. And yeah, that's definitely become a huge question in terms of, where does that start affecting, direct rents with landlords in place in the market.
Have rents moved, Julian, with all these sublets? What have we seen? Are landlords getting more aggressive?
So that's a great question. In terms of direct rents since the beginning of the pandemic, most markets in Canada, and especially in Toronto, have overall bucked the trend of reversing rents. And in fact, rents have actually gone up during the pandemic, over 8% since the beginning of Q1. And so,
rents have gone up during the pandemic. They've gone up 8% since Q1. What's driving an increase in rent right now?
So, that's a great question. And it dives into a bit of our methodology because we track, available asking rents. That is a little bit more sensitive to quarter by quarter movements, as well as an increase in availability in the market, right? That means more buildings to track and more rents to track. Although another big reason why we've seen that increase is, like we've been talking about, when we came into the pandemic back in Q1 2020, we had a vacancy rate of 1.9%. So really, there wasn't a lot of availability to track on, and there was, most buildings in downtown Toronto didn't have available space at all. Now, all of a sudden, they have space coming back to the market. They're putting their space back, and landlords are going, well, what do I put in terms of my asking rent for this space when I haven't had an availability in, 1, 2, or 3 years? So what they're going to do is they're going to look at market. Well, what's market? And, if we were talking about in Q2 and people were asking what's market, the only thing you could peg it to was what it was in Q1, right? Pre-COVID and pre-pandemic. So a lot of landlords are coming out and posting these spaces at pre-pandemic rates. And so all of a sudden we have a lot of these higher rates coming back up to pull that average up.
Well, so let's talk about that anecdotally, because I think the stats here are important in terms of where rents have gone, but I don't think that's the full story, because there's 2 factors that I'm going to point out here. One, I think the better way to track what the market is right now is by deals done. Actually seeing what comparable lease transactions are happening, and whether it's in your building, whether it's in a competing building, whether it's just in the market in specific. Unfortunately, we don't have enough data during that time to really be able to track. Actively, we were on an annual basis, we were transacting in the millions of square feet. I think this year will be much less than that, obviously. So the better way to track it is actually seeing what deals are happening, and there's just not a lot of deals happening in the marketplace right now. Anecdotally, I think what Mike and I and Julian are hearing from landlords is face rates are always going to be a sensitivity in Toronto. It's an institutionalized ownership group. Valuation of building are based on net rents. I think where we're seeing movement right now is in inducements. So whereas in the start of the year, there wasn't inducements included in many transactions, we are starting to see inducements starting to trickle back into deals.
Right.
Which
so
does
if you're
bring down the
a
overall
tenant right now and you're talking to your landlord, you can expect that number is probably still going to be very high, but they're going to try to throw in some free rent. They're going to throw in some allowance to help you renovate your space. And that's what they're going to try to do to keep you. They're not going to necessarily drop that rental rate. It's just not a market that our landlords do that.
Yeah.
Absolutely. That's a great point. I think that's what and that's what we're seeing, in terms of the research department as well. And that's where we're seeing where the market is going to go in the short term for sure. Like I talked about, rents having grown since the beginning of the pandemic, but if we break that up into Q2 and Q3, most of that growth happened in Q2 when we saw a lot of space being added to the market. Space addition slowed down a little bit in Q3. And the interesting thing is in Q3, that rental growth quarter over quarter decelerated tremendously from about 7% in Q2 down to 0.6% in Q3. So looking at that, I think, now we're getting to sort of the breaking point in terms of what you're talking about here, which is we do expect to see that movement on effective rents going ahead. Where landlords are a little bit more reluctant to reduce their face rents, like you said, that would, affect the evaluations of their properties. But where they do have wiggle room are the inducements. So you're looking at more TI packages or more free rent packages. So you're going to see that movement on effective rent before you see it on asking net rent.
Yeah, I think that's fair. So maybe the last thing to delve into here, and I know this is one Mike and I get asked all the time, whether it's from clients or whether it's from our colleagues all across North America, and they're always amazed by this, is what's happening then on the construction side. So Toronto got down to 2% vacancy, and naturally everyone would think, oh, well, we're just going to start building like there's no tomorrow, because obviously there's a ton of tenant demand. That's not exactly what we saw, though, was it, Julian?
No, absolutely. That's a great point. I think, it took, like you said, we have a very institutional, very homogenous landlord mix in Toronto. And I think because of that, conservative outlook, it did take a while to kick off this current development cycle, which is, quite significant. It's over 10 million square feet. It's the largest development cycle Toronto has seen since the 90s. But it did take a long time of Toronto going through its upswing stage and, repeatedly quarter over quarter seeing that vacancy come down before we really kicked off that 10 million square feet of construction. And now, if we look across downtown, we're at over 70% pre-leased in that 10 million square feet. If we focus in on, just the financial core, we're at about 6.3 million square feet under construction. And in those properties, we're at over 80% pre-leased. So there's a strong pre-leasing volume there that is expected to cushion the market against any supply shocks when those developments start to drop.
And let's just qualify or quantify that 10 million square feet, because everyone hears that number and says, wow, 10 million square feet under construction, that's a lot. So our last wave of construction stopped in essentially 2015. We stopped construction. So between 2015, essentially till 2024, is when that 10 million square feet will have hit. Now, of course, that's going to hit between 2021 and 2024. But if you actually look at it over the entire 10-year horizon, that's only 1 million square feet of new space added year over year over the last essentially 10-year basis, which on a 75 million square foot market, as you've already referenced, is slightly less than inflation.
So when you're is a little bit less than the volume of deals that were being done per year time period. So
that's right.
As space is being gobbled up.
That's right. So it's still, although that relief was absolutely needed and necessary. And to your point, of the 6.3 million square feet in the kind of core and south core right now, we're already at 86% leased. And it's not, I think we'll be 100% leased before most of the doors open on those buildings, if not, well in advance of that. I think it's just so relevant to always reference that when we're talking about new developments is, yes, 10 million square feet is hitting the market. Yes, most of that space is already leased. Yes, it will leave backfill spaces that we're obviously keeping our eyes on, and it will create some relief. It's still not enough. So that next wave then, which now we're already looking into 2024 and beyond, but as we earlier referenced, if you're a large size tenant, you're probably looking for years out in advance, perhaps even a little bit more. We are going to see perhaps a little bit more after that, Julian, or not as much?
I think, considering, if we were looking at pre-COVID, to your point, if you had asked me, 10 million square feet, that's a lot. Do you think it's enough? If you asked me back in Q1 2020, I probably would have told you it's not enough. Although now, if you're looking at, a post-COVID landscape in terms of Toronto, I think you might see, that confidence be tempered a little bit. But throughout the pandemic, we have seen, groundbreakings in terms of new projects in downtown Toronto. Take Hines T3 Bayside, for example. They went on spec and broke ground early in the pandemic in May or June. So you're seeing, these strong bets on not just the Toronto office market, but also, the Toronto labor market, which has a lot of highly skilled and diverse pool of workers, which I think is a positive that'll bolster the Toronto office market going into the future. So, are we going to see the same volume of, 10 million square feet over 2025 to 2030? Not necessarily. But, there are still a lot of proposed developments waiting in the wings that have been, sort of testing the market and testing the waters over the past few months just to see, is that demand still there? Is it going to come back? Is it going to come back with the same volume and intensity? And so, I think that's sort of what's going to couch the conversation around that for the coming years and new developments after that.
I think that's an interesting point in terms of these. There's still landlords who are starting to build and looking to build, because you don't build a building in a day. You plan a building and it's going to come and hit the market 3 years from now, when we're not going to be necessarily where we are today in this pandemic. And for space. So
I think too, Mike, there's only so many land sites. There's only so many land sites left. There's only so many land sites left.
We have like Carterra there, another example, is building a building on spec in this market. And there's some landlords who can do that and are going to take advantage of things getting even better in the next, call it 3 to 5 years, things start to.
Well, and it depends too on what you qualify as your CBD, right? Like I think that's really important. It depends on what you qualify as your CBD, because in the financial core, I mean, there are, of that 8 million square feet that's left within the financial core in the South Core, Julian, that's not even half, I think, of that space that's available. So, anyways, I know
one thing I want to get to, Matt, I think is an important is where we go. We're 3.8% vacancy today. What are our projections, high level, of where this market's going to go that we can expect over the next 12 months if tenants can prepare? Julian,
absolutely. So taking into account, all of these push and pull factors that we've talked about, like tenant sentiment, landlord confidence, not having seen a lot of large spaces being added by our, larger occupiers like the banks, for example. And, just in general conversations that we've had, with the tenant industries out there, we do expect more space to be added to the market in the coming quarters. We did see leasing activity and positive absorption, gross positive absorption come back slightly, but notably in Q3. But now we're seeing, rising COVID cases across most of the major Canadian markets, and, Toronto is no exception from that. On the other hand, we're also seeing, like you said, these new stories of new vaccines showing promising results in early testing. So, that is a bit more of a long-term look. So if we're looking at, over the next few quarters, with lower leasing due to, lower tenant sentiment, looking at rising COVID cases and heading into the winter months, we do expect that vacancy to tick up over the next few quarters. And, as we look into 2021 and start expecting, larger blocks possibly from the banks or other major occupiers. So we do expect that vacancy to tick as high as 8 to 10% by 2024 if current conditions persist. But again, if we factor in, these sort of feel-good news stories, looking at, the promising signs of vaccines and things like that, then, we might have a shorter time horizon for that recovery. But as of right now, looking at current conditions, that's where we're expecting to head in.
I think to your point, Julian, we don't know what market we're going to be heading back into. Are we going to head back into when we have a vaccine? Are everyone going to be back to work Monday to Friday, 9 to 5 again? Is it going to be some sort of hybrid model where people work from home and people take less space? I think everyone's still working through that. We're still working through that with our tenants. So it's just something to note. So I think that's
an interesting point on that. Julian set up to 10% is the GTA West markets, suburban markets, has functioned in between 13 and 16% for a decade. You look at Chicago, it's a market that's functioned in the 10 to 12% range. So even if we hit that high level, Toronto's just become a more balanced market. It's not like 10% means.
Yeah, that's a really good point, Mike. And I think that's probably a good place to wrap up on, because it's so market specific. It's so nuanced. Again, we're double from where we were in terms of vacancy rates at the start of the year, but we're still the tightest in North America. So it really just depends on your market. So obviously, let's thank Julian. Thank you so much. I thought that was incredibly impactful. If anyone wants to get the national report or any other reports, let us know. We'll post this on Instagram. Julian's a great resource, and we're happy to set up calls and other videos. So until next time, thank you, Julian. Thank you, Michael. And we'll talk to everyone soon.
All right. Thank you, guys. It's a pleasure.
Have a great week.